Welcome to Markets Now. I'm Michelle Rook with Ellen Brugler of A&N Economics, and livestock mostly higher. The grain trade mixed, corn and wheat lower, soybeans to the plus side. Well, let's start off with the good news first of all here. Soybeans higher, and we kind of reversed a lower opening there. It looked like we kind of bounced off of some key support, but what's driving that market right now? Because it's been kind of surprising how strong it's been.
Yeah, it has been surprising to me with all the trade talk and the likely export restrictions on beans that the market's held up. It just basically tells you that we discounted the news ahead of time. Even going back to the tail end of last year. The main bullish support here appears to be the vegetable oil, the bean oil. Bean oil's playing with 50 cents a pound, up from over 40 cents a couple of months back. And so that's adding a lot of product value to the beans.
So bean oil at levels here that we haven't seen, I think, since December of 2023. So is that the demand that we're seeing globally because exports have just been on fire here and there's, biodiesel mandates around the world? Or is the market looking forward at the possibility we are going to get those biomass-based diesel RVOs up above 5 billion gallons?
In the U.S. case, it is very dependent on getting that increase in the required blends. And the fact that if it's all renewable, which is the trend here and in the preliminary results of those meetings, renewable does take a little bit more bean oil to make than the conventional biodiesel. So, it's a consumption thing. But again, it's very dependent on it. It does not pencil to take 50-cent oil and turn it into diesel at current diesel prices without some kind of requirement, a binding requirement in the market, or some subsidies to make it work.
Corn and wheat lower on Monday. Let's talk about corn first. Was it just anchored by wheat, or is this the idea that we're going to have more acres, maybe over 96 million?
I think there's a lot of talk about that out in the industry. The soy corn ratio still kind of suggests more corn. You've got rapid planting progress to start off the season. Trade was looking for about 27% or so planting on Monday night. That suggests more acreage in the end if you get off to a really good start on planting. The market's fairly optimistic, I think, still on corn demand overall. We're not as dependent on China. They're hoping to get a fairly quick deal with Japan that includes some more buying there. And year to date, we're up 28% on exports for corn versus a year ago. So in a tighter world environment. So, that all sounds positive, but then you look at wheat and you say wheat's going into what's probably a seasonal low or a pre-harvest low. And it's going to probably see better crop conditions over the next week or two because of improved moisture. And so, wheat's to a degree, wheat's dragging corn down. The other thing would be that increase in acreage that people are kind of suspecting here.
So wheat has been making new lows here just because of this favorable weather, but how low do you think that market has to go here? Because demand hasn't been that bad.
No, demand's been pretty good. Of course, we're at the tail end of the marketing year for U.S. wheat. That ends on May 31st. The export shipments are up double digits percentage-wise year to date, and that's the good story. And world wheat stocks usage ratios are still pretty tight. We had been looking for a little more aggressive rally month end into May because of those tight global stocks going into the end of the marketing year. But again, there is a 9-year cycle low due in Chicago wheat here in 2025. You'd only have to go down to about 490 to make that happen. And we're not that far away from it in the nearby wheat contracts. So I'm not saying we're going to get that, but certainly it's acting like it at the moment.
Let's also talk about tariffs and trade. The clock is ticking on this 90-day delay here to get some of these deals done. Do you think we're going to get a lot of the deals done before that time period? I mean, you're talking about a lot of work that has to be completed.
There's a lot of work that has to be completed. They were trying to streamline the process a little bit. I believe there's 55 countries that over the weekend they indicated they're trying to use kind of a standardized model on how to solve the deal and get it signed and get it implemented. Sort of an A B C D E, because otherwise you just can't deal with that many individual agreements. The linchpins are, I think India is a big one in terms of if we can get that closed. Not so much because they're a huge ag import buyer, but because it makes sense if you're trying to contain China that you have India on your side and playing with you. Japan's another one that is important because they are a major buyer of U.S. ag commodities and are in a position to potentially increase the percentage. Soybeans, for example, if Brazil sends more soybeans to China, they maybe send less to Japan, and that gives us an opening. Uh, it's ambitious to try and close all those deals in 90 days, but uh, I think just getting a few of them across the line is important here. You're not going to get uh, rapid results. I mean, you shouldn't expect it in the first 2 or 3 weeks after that suspension that you got the deal signed. It's just a much more complicated process than that.
New contract highs in both live and feeder cattle futures on Monday. And of course, it's been driven by record cash, but also strong demand.
We're still at that point in the cattle cycle. We've got very tight ready numbers here relative to previous years, and you've got the packers want them. I mean, the consumer has, while they may be cutting back in some other areas, is still supporting the box beef price pretty well. The closeouts are phenomenal for some of the feedlots that we talk to at this level of cash, and given what they've got in the corn and the feeders. They're very happy with the current situation. The question is, when do we turn this around? And one additional variable there, of course, is the talk about tightening up the screwworm restrictions again, or the fact that Mexico may not be meeting the administration's expectations there. If you do tighten up imports of feeders and other animals because of that, that just adds another ratchet onto the cattle.
Is there anything in your mind that could stop or turn this thing around in the cattle cycle?
Well, you got short term and long term. Short term, we can have a $5 or $10 break in cattle at any time just because of profit taking. I mean, the funds risk managers say, hey, we've got a big chunk of money made here. We're up against some chart count or some resistance, or they just need money to go elsewhere because of margin calls or asset allocation. So yeah, we can get those kind of corrections anytime. To put the cattle cycle peak in place, you about have to see increased heifer retention and actually increased calf numbers, and there's a big chronological gap between those two. Uh, the that's the other thing that would put a hammer in the top here. I will point out that on an inflation adjusted basis, we're still not to where we were in 2014 for either cattle or hogs. But the scenario is different than 2014 in that we had PED in the hogs in 2014 and a much restricted supply of pork.
Yeah. Speaking of hogs, new highs for the move again in the hog market. Is this just fun buying, or is this strong demand, or both?
Well, you've got tighter supplies for one thing. Your pork production year to date's down more than 2%. The cold storage report last week said that for the end of March, stocks were the tightest for that particular month since 1997. So part of this is just a scarcity argument. Seasonality is playing in here. Normally, hogs will rally from April into June or July. That's not bulletproof, but a lot of years you see a seasonal increase there once you get past that peak slaughter for the spring run. And I think the traders are playing that, whether that's the commercials or otherwise. You and I discussed on off air that the negotiated hog price is actually stronger than the formulas in some cases here. That's unusual, and it suggests that there is a little bit of tightness in the cash hog supply here.
Well, great to talk to you as always, Alan Brugler with A&N Economics, and that is Markets Now.